So this is our last chapter on current assets. We're going to talk about inventory and cost of goods sold. And in chapter 5, we brushed on the topic of cost of goods sold, but we're going to get into more details in this chapter.
This is sorry.
What was that?
I was just gonna say, is this still chapter 6?
Yeah, this is chapter 6.
Okay. Thank you.
And I can't write that high. It's chapter 6. Okay, so we're going to go through an example just of the journal entries for related to inventory and then what happens when we sell inventory. So we're going to use Scarves for You as our example company. And they sell scarves, shockingly enough. And they purchased 5 scarves at a cost of $10 per scarf on account. During the period, they sold 4 of those scarves for $50 per scarf. And they started with no beginning inventory. So in my inventory account, what type of an account is this?
Asset.
An asset. So it has a normal debit balance. So the beginning balance showing that they have no inventory is going to start here on the debit side. 0 units in beginning inventory. We're going to record the purchase of the inventory and the sale of the merchandise to our customers, including all entries that are required for that. And then we're going to calculate gross profit. So when we purchase inventory, inventory is an asset, so it's recorded at our cost basis, right? Historical cost. How much it cost us to purchase those goods that we're intending to sell in the future. What is our cost basis for this example?
$10 per scarf.
$10 per scarf. When we record the purchase of the inventory, we're going to take the cost basis, which is $10 per scarf. So $10 per unit times what? To determine the total amount of the purchase.
Times 5.
Times 5 units, right? Because we purchased 5 scarves. So how much is this going to impact inventory by?
50.
$50.
Yes, continue.
When I make a purchase of inventory, what am I going to debit and what am I going to credit?
Inventory, and if we're buying on account, then accounts payable.
Yes, so debit inventory, increasing inventory for those 5 units that we purchased, so for $50. And we're going to credit accounts payable, increasing accounts payable. We now owe $50 for that inventory that we purchased. So what happens in our inventory T account? We now have 5 units at $10 per unit for a total of $50 that we're increasing inventory by. During the period, we sold 4 scarves for $50 per scarf. So we're going to have 2 different journal entries to record that sale. One to record the actual sale and the other to record the cost of that sale. right? Matching that expense with the revenue that was generated from having those goods available to be sold during the period. So to record the sale, how many units am I going to use?
4.
How many units am I going to recognize as
5.
revenue?
5 units.
Is
Did I
it
sell
4?
5?
No, 4. You sold 4 units. So
So I only sold 4, right?
yeah.
So 4 units were sold. And when I sell something, I'm going to record it at what?
The selling price.
The selling price. So each of those 4 scarves were sold for $50 per scarf, or $50 per unit. So in total, how much am I going to recognize as revenue from this sale?
$200.
$200.
$200, correct. And it doesn't say if it was on account or for cash, so let's just say it was for cash sale. So what are we going to debit and what are we going to credit?
Cash and sales revenue.
So we're going to debit cash, increasing cash. So that's what we received for $200. And we're going to credit sales revenue. Jason, it'll always tell you. I just forgot to include it. And we're going to credit sales revenue, increasing sales revenue by $200, recognizing that revenue is earned. At the same time, we also need to record the cost of the sale, the expense related to that sale. Right? If we didn't have those units, if I didn't have those scarves to sell, I wouldn't have made that revenue. So how many units should I be expensing?
4.
4 units. Only 4 units were sold, so only 4 units are going to be expensed as cost of goods sold. This is key. And later on in the chapter, when we get into the different methods, this is the part that confuses most people. You only expense as cost of goods sold the number of units that you actually sell. What happens to the rest of those units?
They're part of the inventory we still have.
They still sit in ending inventory. They're still part of your assets as an inventory. Those 4 units that were sold are going to be expensed at what cost? $50 or 10?
10.
$10 per unit, our cost basis. So we're going to have an expense of $40. What goes into and out of our inventory account is always at the cost basis of those units, purchased and then sold. So we're going to debit what account?
Cost of goods sold.
Debit cost of goods sold. I'll write it out this time. So debit COGS, increasing the expense for $40, cost basis of those units sold. And we're going to credit inventory. Decreasing inventory for those units that we sold during the period. They are no longer available to be sold in the future. So what happens to our cost of goods sold account? We had a beginning balance that was 0 because they hadn't sold anything else previously. And we debited cost of goods sold in the journal entry for 40. So we're going to debit cost of goods sold in the T account. And the ending balance is $40, which represents the 4 units sold at a cost basis of $10 per unit. Cost of goods sold is literally the cost of the goods sold during the period. That's the definition. In my inventory account, what should my ending balance be?
1.
Not 1.
10.
$10. It should be the equivalent of 1
Oh,
unit.
inventory. I'm sorry. Yes.
1 unit at $10 per unit cost. Because we still have 1 unit left to sell in the future. Still an asset, right? We still have it available to be sold in the future. Let's see if we were correct in what we did. 4 units were sold at $10 per unit, which is what we credited to inventory. So $40 was credited to inventory in our journal entry. $50 plus 0, beginning balance, minus the 40 gives us 10. We started with 5 units in inventory. We sold 4 and we're left over with 1. Are these journal entries somewhat familiar?
Yes.
Yes.
Good. Questions on the journal entries or the T accounts at this point?
No, could you just scroll down a little bit to see the last one?
Yes. Better?
A little bit more.
Okay,
Thank you.
no problem.
Professor Wade,
Yes.
something I've noticed is that every time we do examples, or not sometimes when we do examples, when we do examples, I get confused. But then once I do them on my lab, they're like really simple.
Yeah, that's common. That's why
Okay.
practice is key in accounting. Because
Yeah.
I'm teaching you the first time and you haven't seen it before, and then when you practice it, then it clicks.
Yeah.
That's what I would expect. I don't expect you to come in and hear it and then be like, I know this and ace everything.
What was that?
Okay. We're going to talk about gross profit related to this as well. Gross profit is the excess of sales over the cost basis of the units sold. So basically it's telling us how much above cost we were able to sell our goods for. So how much we were able to actually mark up our products by. What was the market willing to accept from us? Because depending on what type of industry we work in, we may not be able to mark up our goods that much. If I'm in a highly competitive business, or if I have a lot of turnover of my inventory, such as a grocery store, the markup is very slim. The margins, the gross profit that they're earning from each unit sold is slim, but they make up for that difference in the turnover, the number of items that they sell during a period. Gross profit's a very simple calculation, and most companies do disclose this in their financial statements. It's not required because some companies will use that single step income statement and not disclose cost of goods sold separate from all of their other operating expenses and calculate gross profit. But a lot of companies do, and investors do care about it. The calculation is sales revenue minus cost of goods sold. Gives us gross profit. And we do sometimes refer to it as gross margin. It's the same thing. Gross profit is relevant because in order for a company to pay their other operating expenses and run their business, they have to have enough gross profit in order to do so. If they have a deficit at the gross profit level, meaning they're selling their goods for less than their cost of those goods, then they don't have anything to cover those other operating expenses. So they're guaranteed to have a net loss. They're not going to remain in business very long. For sales revenue, for this example that we looked at, how much did we record as sales revenue? $200? Oh. You guys still there?
Yes.
Okay.
Yes.
Sorry, I wasn't sure if it froze and I lost you. Okay, so sales revenue is 200. Cost of goods sold
It's 40.
is 40. So we're subtracting cost of goods sold from sales revenue, and the gross profit, the
160.
excess of sales, is 160. Now, the 160 doesn't tell us very much. But what really is important is calculating the gross profit percentage. So gross profit as a percentage of sales. So what we're going to do is we're going to take, see, forgot to erase that, sorry. Gross profit, which is 160 in our example, divided by sales revenue of 200. And in this example, what is our gross profit percentage?
80%.
80%. Oops, not a dollar. So for every $1 of goods sold, 80 cents of that dollar goes to covering our other operating expenses and providing profit, net income to the company. That's extremely high. Most companies are not going to have 80% as their gross profit percentage. But the calculation for it is the same. questions? Okay. Are you guys ready to move on?
Yeah.
Okay. Okay. So there are a few things that are going to influence the value of inventory, the cost that we're recording as inventory. And it's also going to impact the amount of cost of goods sold that a company is recording during a period. First one is going to be the number of units in inventory. So the very first thing that we do with inventory to determine how many units of inventory the company has at the end of the period is that we're going to do a complete physical count of inventory. So if you've ever worked in retail before, you may have had that lovely experience of being present during an inventory count. And if you're even luckier, you've had the experience of having auditors there during an inventory count, where we do test counts and we sometimes make you recount things. But basically what we do is go to every single warehouse that a company has, and on a specific day, which is usually period end of the year, we're going to do a full, complete inventory observation and count down all of the inventory items that they have on hand as of that last day of the year. So we start with our physical count of inventory. That's our starting point for the number of units. And then we may know that we have some other items that are on hand that are not actually ours. So some of the units that are on hand in the physical inventory count are not owned by our company. They're owned by another company. So another company's consigned goods on hand at period end, so meaning that we had another company's goods sitting in our storeroom, usually available for sale. Those aren't our goods. We don't own title to those goods. It's just a consignment relationship. So basically somebody can say, oh, I have this product, this jewelry, and you have a store. And one way of selling those jewelry items in the store is to consign those items for the other company. So maybe I haven't sold this type of jewelry in my store before, but I want to test it out. But I don't want the risk of the jewelry not selling and having that cost associated with those units. So I can say, you can sell your goods in my store, but I'll take a little percentage if these items are sold, a consignment fee. We don't own those goods, even though they're on hand at our facility. The other company owns those goods. So we've included them in our complete physical count of inventory because they're on hand at our physical or at our company, but we need to track them out because we don't actually own that inventory. If you've ever walked into a casino, on top of a set of slot machines, what do you typically see at the entryway of a casino?
Security guard?
No, besides that.
ATM.
Nope. Good one though. Up high.
Cameras?
Not that high. Halfway between there. So it's usually on display, a shiny new car.
Oh, okay.
You win the jackpot, you can win this beautiful car, whatever it is. The casino doesn't own the car. The casino, if you win the jackpot and you select to win the car will purchase the car at that point in time. Most people who win the jackpot don't actually want the car. They want the cash value of the car. Who owns the car?
Whoever's the dealership or whoever's displaying it there. Yeah.
Dealership. So it's considered a consigned item for that dealership. Now, if we have our own consigned goods at another store's location, our consigned goods at another company's location, who owns those goods?
We do.
We do. So what do we need to do with those goods? Our goods that are at another company's location. We need to add them to our count because we didn't include them in our physical account of inventory because we didn't have them on hand at period end. They were at somebody else's location. So now we know we have those 5 units at another store's location. We didn't include them, so we need to add them back because it is our inventory. The other portion that we need to think about has to do with the in-transit terms and goods that are coming into and leaving our facility. So we need to think about our shipping terms. So we'll go over to the right for a second. What just happened? That. Okay. So for our shipping terms, we have 2. FOB shipping point, free on board shipping point, and then FOB destination. We talked about these in the last chapter. So for FOB shipping point, legal title of the goods passes to who when the items leave the seller's place of business?
To the purchaser.
To the buyer. So upon shipment, the buyer becomes the owner of those goods. So who owns those goods while those goods are in transit, meaning while those goods are shipping? Who owns those goods?
The buyer.
The buyer. And the buyer is also the party that's going to be paying
The shipping costs.
the shipping costs as well as the insurance and freight costs in transit. So we sometimes refer to that as freight in. The good news is if I'm the buyer and I'm buying goods FOB shipping point and I have to pay for that insurance, I have to pay for those freight costs, I get to include it as part of my inventory costs. So it's fine that I have to pay it. I'm still going to get it to include it as part of my inventory cost. On the other end, we have FOB destination. So when does title transfer for FOB destination?
At the buyer's location.
At the delivery to the
Delivery
buyer,
point.
right?
Yeah.
So title passes to the buyer when the goods are delivered. So who owns those goods while the goods are in transit?
The seller.
The seller owns the goods while they're in transit. And the seller is going to pay all of the transportation costs. And guess what? As a seller, if I'm selling the goods FOB destination, those in transit costs, my freight out, my insurance for those goods are not going to be part of the cost of inventory. It's part of an operating expense. So these are going to be expensed as operating expenses. So when we're thinking about number of units that we actually own of inventory at period end, and we're using these shipping terms, purchase goods in transit, FOB, what need to be added? Because these are already gone, or I'm sorry, these are goods that we've purchased. We're the purchasing company. We're buying inventory. And if these goods are in transit, under which terms do we actually own them?
Shipping point.
Point. Yep. So any of the purchases that a company makes, as long as the buyer, or I'm sorry, as long as the seller has actually sent the goods already off to UPS, FedEx, the shipping has begun, that means that those units in transit are ours. So obviously we're not going to have them at our physical inventory count, but we need to add them back in because those goods are technically ours at period end. Those units that we purchased that have left the seller's facility but haven't arrived yet. Now, if we sold goods, so we are the seller, which goods do we own in transit as the seller?
FOB destination.
FOB destination. So goods that we've sold, FOB destination that are in transit at year end are still technically ours. So we need to add back those goods that we sold that are in transit. So calculating the number of units in inventory is extremely important to have accurate because it is going to have a direct impact on the amount of revenue that we're going to recognize and the cost of goods sold that we're going to recognize. As an auditor, inventory is a heightened fraud risk for us. It is something that we're monitoring. It is because there can be manipulation of earnings by using inventory. Okay. One last thing, and then we're going to take a break. The purchase, the net purchases, the costs of net purchases. So our cost basis, if you will. Our cost basis, we're going to start with the purchase price of inventory from our invoice. And our cost basis is also going to include freight in. So shipping costs to get those goods to our facility if we as the buyer had to pay them. So if the terms were FOB shipping point, and we had to pay for those goods to arrive at our facility, we're going to include the freight costs as well as the insurance costs in transit as part of the cost of inventory. If we returned any units of inventory because they were damaged or we didn't want them, that's gonna reduce the purchase price or net purchases. So purchase returns are going to reduce the cost basis of our inventory. If some of our units that we received were damaged, so damaged in transit, or maybe damaged and we purchased them damaged and we knew they were damaged and we got a discount, purchase allowances. It could also be that we received a discount because we took advantage of paying for the inventory early. Purchase allowances. For those purchase discounts, we would offset and reduce the net cost of our purchases. This cost basis is going to be different depending on the different methods that we're going to talk about next. So we're going to take a 10-minute break here. So in terms of how we cost inventory, to this point, we've always just assumed specific unit cost was being made or being used, but there are a lot of options for companies to select from, and there's 4 of them that are the most commonly used. So you have specific unit cost, average cost, and then FIFO and LIFO, and I'll go through it down below. But depending on the company's situation, they may choose to use one of the methods over another. This is the first kind of methodology of GAAP that we're allowed to actually select what method we're using to determine our cost basis. In previous chapters, and all of what we've learned so far, GAAP tells us what to do. But now GAAP states that companies have this ability to select what method they're going to use for financial reporting purposes, and whatever they use for financial reporting purposes, they're also required to use for tax basis and tax reporting. And they have different values of inventory as well as cost of goods sold that will be shown and sometimes have a huge impact on the company's bottom line, depending on what method they're using. For the first method, the specific unit cost, this is used only by companies that have very unique inventory items. Because it's extremely expensive to use. So companies that sell cars, automobiles, antiques, high-end jewelry and jewels, and real estate are going to be using this method. The reason being is because the way that we're expensing these items, or we're saying that this specific unit of product was sold, and this specific unit of product had this cost basis, and this is how much we're going to expense this unit for. So we have to know exactly how much that specific unit cost that company. if a company like Costco was to use specific unit cost, think of how many millions of units are being sold each day. They would have to know the specific cost of that specific unit that was sold to figure out cost of goods sold. That's not going to work for them. It's just too ridiculously expensive to do that. But a company that's selling real estate and they have various real estate holdings, they have some units that are some houses that are 500,000 cost basis, some that are 5 million cost basis. If you sell the $500,000 house, you shouldn't expense 5 million or a blend of the costs. You should expense the cost basis for that one house. And since typically real estate holders don't have a substantial amount of inventory that's being bought and sold each period, it's not very difficult to use that specific unit cost. The more likely methods that companies are using are either average cost, FIFO, or LIFO. Average cost is producing an average cost per unit. And it's a weighted average. So each period, what we're going to do is we're going to calculate cost of goods available, the number of units available, and calculate an average cost per unit to use to value cost of goods sold, as well as the ending inventory balance. I'm not going to get into the calculations yet because we're going to look at an example and use the calculations then. So don't worry about the wording. We'll get there. The next method that's available is FIFO, first in, first out. And the name stands for how we cost of goods sold. So this does not mean that operationally this is how they sell their units. It doesn't matter, but from an accounting perspective, we are going to expense the oldest items first as cost of goods sold. So the oldest items are expensed first. So we're starting with our oldest inventory, our beginning balance of inventory, and then we're working our way forward layer by layer until we reach the number of units sold to calculate cost of goods sold. So ending inventory is the newest items purchased. It's what's left over. When we're in inflationary periods where prices are rising, FIFO is going to provide the lowest cost of goods sold value because we're expensing the lowest cost items first. So FIFO will provide the highest net income out of all the methods in an inflationary period. So publicly traded companies may use that to their advantage. If they want to report a higher net income, they're going to use FIFO.
Professor, wait, as well, this kind of inventory FIFO is very common in the restaurants to use that as
FIFO,
well.
for operationally, most companies are using FIFO. It doesn't, restaurants can use FIFO for external reporting purposes, for accounting purposes, but they don't necessarily have to. It just depends. It doesn't even matter. You could have two companies in the same industry, one using LIFO, one using FIFO. Operationally, most companies likely use FIFO, especially restaurants, because their goods go bad. But from an accounting perspective, we don't care what they do operationally. Depending on what method they use is how we present it.
Okay, in accounting, you can choose what is better or works better for that company?
Yeah.
Oh, okay. It could be more internal if the company decide to, it's two different perspective. Is that what you mean?
So operationally, it's best business practice to do FIFO for operation. They should be selling the units that are the oldest because they become obsolete, like new technology replaces it, or they have damages. It just gets bad. They go bad. The crops go bad, etc. The food has expiration. But from an accounting perspective, they could be using LIFO to expense. But operationally, they're still using FIFO.
Okay, thank you.
LIFO, last in, first out, is the only method that is not allowed under IFRS, the International Financial Reporting Standards. It's a big reason why we will never fully converge with the International Financial Reporting Standards. US companies like LIFO because of the tax benefits that LIFO provides to these companies. LIFO stands for last in, first out for costing cost of goods sold. With LIFO, we're assuming that the newest items purchased are the first to be sold. So are sold first. Ending inventory is going to consist of the oldest items purchased. It's the opposite of FIFO. For LIFO, especially in inflationary periods, which most of the time we're in, costs are rising. LIFO is going to provide the greatest cost of goods sold, so the highest expense, the lowest gross profit, and the lowest taxable income. So the lowest tax basis. So it's going to save companies money in the amount of taxes they will have to pay each period. So yes, it might provide a lower net income, which it will, but it's also having a tax savings for the company. So a company might select this even if they're publicly traded because they know that their investors are sophisticated enough to understand why they're using LIFO. And that because they're using LIFO, it could make them have a lower net income than a competitor that's using FIFO. And that's the only reason. LIFO also can provide a way for companies to manipulate earnings legally, 100% legally, because they can make a large purchase at the end of the period at a higher cost per unit, and those units are then expensed first under LIFO because they're the newest items purchased. So if they look at their books, they realize that their revenue was higher than they were expecting, and they're dipping into some of the older layers of inventory, which are cheaper, and they need to get their cost of goods sold higher to reduce their taxes, they can make a purchase at year end to do so. So we're going to go through an example. And before we start the example, we're going to do some setups. So before we go through each of these separately, we're going to set it up. During the month, Army-Navy surplus had the following beginning inventory and purchases. Army-Navy surplus sold 318 tents during March. The sales price of each tent is $45. We need to determine the cost of goods sold and ending inventory amounts for March under the average cost, FIFO, and LIFO. Round average cost per unit to 2 decimal places and round all the other amounts to the nearest dollar. Before you even get started, so this is the record of inventory right here. We're going to calculate a few things. So we have our beginning inventory, what we start the period with. So as of March 1st, they have 75 units that they paid $16 per unit for. And then they made 3 purchases during the period. And what do you notice? The number of units they purchased are all different. And the cost basis, the amount that they paid for each of those units, is different. They're in an inflationary period of time. So this is very common. These different layers of inventory that we have are all at different costs. First thing that we want to calculate is the number of goods available. So how many total units do we have available? And that's going to be the sum of beginning inventory, the units in beginning inventory, plus the number of units purchased.
$71.
So 371 units were available at the end of March. The next thing that we want to determine is either going to be the number of units in ending inventory, or it's going to be the number of units sold during the period. Depending on what happens or what was given to you will determine what you need to calculate. So we have the number of goods available. From this, we know that some of them are going to be sold and expensed as cost of goods sold. Some of those units are still going to be available next period. So if you think here, we'll look at the T account for inventory. So we have beginning inventory, and I'm going to look in units only. We had 75 units in beginning inventory. And then on March 3rd, we purchased 95 units. On March 17th, 165 units were purchased. And then on March 23rd, we purchased an additional 36 units. And we added those up to get the 371 units. Up at the top, they gave us information. It said Army-Navy surplus sold 318 tents during March. So did they tell us how many tents were left over? Or did they tell us how many units were sold during the period?
How many were sold?
How many were sold? So the reduction. So 318 units were sold. So the credit to inventory and that debit to cost of goods sold. So we're going to expense 318 units as cost of goods sold. And we need to figure out how many units are left over in ending inventory. So we can take our number of units available, which is 371 units, the sum of beginning inventory plus the purchases, and we're going to subtract number of units sold, which is 318 units, to back into number of units in ending inventory,
53 units.
53 units. So if you're given the number of units in ending inventory, you're going to do the exact same thing. You're going to take your number of units available minus the number of units in ending inventory to back into the number of units sold. Under each of the four methods that we're going through, you will always only expense 318 units sold. And you will always only include 53 units in your ending inventory balance. The value of cost of goods sold and the value of ending inventory will differ depending on the method that we're using. After you calculate the number of units in ending inventory, we need to calculate our total cost or extended cost for each of these layers of inventory. So we purchase this number of units for each layer at a cost per unit, cost basis per unit for each layer. So we're going to take the number of units purchased times that cost basis per unit to calculate the total cost for each layer of inventory that we have. So for beginning inventory, we purchased, or we had 75 units in beginning inventory at a cost of $16 per unit. What's our total cost for this layer?
1,200.
1,200. March 3rd, we purchased 95 units at $18 per unit. And this layer has a cost basis of
1,710.
$1,710. March 17th, we purchased 165 units at $20 per unit. And this layer has a value of
3,300.
3,300. March 23rd, 36 units were purchased at $21 per unit. Total cost of $756. We're going to add up this column to calculate the cost of goods available. Cost of goods available is the sum of beginning inventory plus the purchases. So this is how much in inventory costs we had available to sell during the period. We didn't sell all of these units during the period, but this is the total inventory value available during the period. When you calculate this, double check that you always have it correct. You'll want that number to be correct. What was the total cost of goods available?
6,966.
6,966. Any questions on what we just went through?
So we're going to be using average cost of goods sold.
We're
in
going to
this
use all
crisis?
of them. We're going to calculate inventory under each method for this example.
Oh, okay.
So companies are only going to use one method, whatever their desired method is. And if they change, it's a rare change, but we're going to go through each of them so you can see the difference between them. We're not going to go through specific unit cost right now in the example, but the practice problem you'll go through next class, you will do it. So you'll get some practice with specific unit costs then. And the reason is because we've been using specific unit costs this entire time. Now, something that you need to know about your homework for this particular chapter, there's a box that you just put your answer in, and I think that that's what confuses people. So definitely have your work written out on a piece of paper so that if you do calculate the wrong number, you have all of your work and you know which direction and what you did to calculate it, to double check your work. So for average cost, we're going to first calculate an average cost per unit. And guess what? We've already calculated the two pieces that we need. Average cost per unit is calculated by taking the cost of goods available divided by the number of units available. So we first figure out how much in total inventory we had available during the period. And we put an average cost to that inventory that we had available during the period. It's a weighted average cost. So we added up the total cost of inventory. We calculated 6,966 in our cost of goods available. We're then going to divide it by the number of units available. So number of units in beginning inventory plus the number of units purchased, which was 371 units. And we're going to calculate it to a penny. So you will have some rounding here. If the number after the second number is 5 or higher, you're going to round that last number up. So per unit, you should have calculated $18.78 as the average cost. We're only using average cost, the average cost per unit for the average cost method. And something to think about with the average cost is the average cost per unit that you calculate should be between, in this case, $16 per unit and $21 per unit. Is 1878 between that range of 16 and 21?
Yes.
Yes, it should be. It is. And it's just kind of a check. If you're calculating average cost that's outside of that range, then you know that you made a calculation error somewhere. After you calculate that average cost per unit, you use that average cost per unit to calculate cost of goods sold and the ending inventory balance. Cost of goods sold is going to be the average cost per unit times the number of units sold during the period. We're always expensing the same number of units, but our cost basis per unit that we're using differs depending on the method that the company selects to use. If they're using average cost, they're going to expense $18.78 for every unit that they sold during the period. In this case, how many units were sold during the period?
Is it 371?
371 units.
So 371 units were available. That's how many units they had in total. Did they sell all of those units? Meaning, should they have 0 as their ending inventory balance?
Yes.
They sold them all?
I can't see the problem.
Look at your T account.
No, they only sold 318.
They only sold 318. So we're only expensing 318 units. So during the period, they sold 318 units. That's how many we expense as cost of goods sold. We multiply that times 18.78 per unit. Our average.
972.04.
So I don't care about the pennies. I'm just going to round those off. 5,000.
972.
972.
972. And that would be my debit to cost of goods sold, credit to inventory to recognize for cost of goods sold during the period if I'm using average cost. Ending inventory represents what's still left over, what's still on hand available for the next period. What we're not expensing this period because we didn't sell those units. If a company is using average cost, they're going to use the average cost per unit again of $18.78 per unit. And we're going to multiply that times the number of units in ending inventory. At period end. So how many units are still on hand at the end of the year? Or in this case, at the end of the month?
53.
53 units.
$995.
So 53 units on hand times 18.78 per unit rounds to $995. So this will be our ending balance of inventory. $995. Because we had some rounding, this won't come out exactly, but when you add these two numbers up, they'll come out to roughly 6,966. Cost of goods available. It's just a check because what we're doing is we're separating that 6,966 into cost of goods sold, what we're expensing for those units sold, and then ending inventory. But because we have some rounding with average costs sometimes, it's slightly off, and that's fine. But it's just a kind of check for you. Usually students aren't too confused on average cost, but do you have any questions? Okay. Do you want to jump to FIFO? FIFO, you're going to need to draw some tables. So for FIFO, I need you to write 2 different tables, including the same headers: the date, number of units, cost per unit, and then total cost. We're going to do 2 tables. One table is going to be FIFO's cost of goods sold calculation. And then the other table is going to be FIFO ending inventories calculation. FIFO and LIFO are directionally telling us how to expense inventory. Their name stands for how we expense cost of goods sold. Under all of the methods, we will always expense the same number of units. Under all of the methods, we will always have the same number of units on hand in ending inventory. So for FIFO, first in, first out, for costing cost of goods sold, we're assuming that the oldest items in inventory are expensed first. So FIFO, cost of goods sold, we're going to start from the top and work our way layer by layer towards the newer items. So, did we sell at least 75 units this month?
Yes.
Yes, we sold 318. So we're going to expense all of beginning inventory. So with FIFO, cost of goods sold, we always start with beginning inventory because it is the oldest items on hand. 75 units are in beginning inventory at a cost basis of $16 per unit. And because we're expensing the entire layer, we're going to expense all $1,200 as cost of goods sold for FIFO. So I can do a little check mark here. I've already expensed them. Once I expense these units, they're gone. They're not going to be included in my ending inventory calculation. Then I move down one layer, March 3rd. Did I sell at least 95 more units?
Yes.
Yes. So 75 plus 95 gives me 170 units sold at this point that we've accounted for.
Mhm.
So we're going to expense all of March 3rd layer. 95 units at a cost of $18 per unit. And the entire $1,710 is expensed. I'm going to do a little calculation off to the side. So we have to expense 318 because that's how many units were in total sold. We expense 75 in beginning inventory and then 95 units. So how many units do we have left to expense?
260.
One more time, sorry.
260.
No.
No, it should be less than that, sorry. 148.
Okay. I'm taking the 318 for the, it's not that? Or should I take the 371 units in total?
318. Not the 371, because the 371 is the total available. Just the 318. So 318 minus the 75 minus the 95.
Okay.
So we have 148 units left to expense. The reason why I did this was because if I look at this next layer, March 17th, I purchased 165 units, right? So did I sell all of those units?
No.
No. I sold only 148 of those units. So I'm going to expense 148 of those units. And how many units are left over from that layer?
17.
17.
17.
So for my March 17th layer, I'm going to include only 148 units because in total, I need to only expense 318 units sold. Because I'm only expensing the number of units sold during the period.
Okay.
And 148 units are going to be expensed at a cost basis of $20 per unit. And so in this layer, how much is going to be expensed? Not the 3,300, because not all of them were sold, but only 2,960. So the whole reason for doing this thing off to the side was to figure out how many additional units I needed to expense. You can do that in your head, you can do it on your calculator, but you need to go through that process because at some point when you're calculating FIFO or LIFO cost of goods sold, you're going to have to break up a layer. You don't ever jump down to a different layer. You always go in the exact order and you break up the layer that you're left on.
Okay, so, the total one is 5,870.
Yep, FIFO, cost of goods sold, the amount that we're going to expense as cost of goods sold is 5,000. Beatrice, what was it?
870.
870. So I want you to notice something. Same number of units were sold, right? Same number of units were expensed. And FIFO, cost of goods sold, was 5,870, lower than what average cost shows. Average cost, you would be expensing 5,972. FIFO in inflationary periods will always provide the lowest cost of goods sold. The lowest amount to be expensed will always be from FIFO. Average cost is in between what you would calculate for a cost of goods sold for FIFO and LIFO because it's using a blended average. It's just kind of a little check that yes, indeed, FIFO's cost of goods sold is lower than average cost, which it should be. Notice that under average cost, we expense the same number of units, 318 units sold. That's how many we expense for FIFO. Now, after you complete cost of goods sold for FIFO, you need to calculate the ending inventory balance for FIFO. And you're going to use the table again. The date, number of units, cost per unit, and then the total cost. For FIFO ending inventory, what we have left over is the newest items. So in inflationary periods, FIFO's ending inventory is basically telling us replacement cost. It's the most accurate in terms of replacement cost. And it consists of the newest items in inventory. So we're going to be starting from the bottom for FIFO ending inventory. So March 23rd is the first layer we're going to include. And do they have at least 36 units in ending inventory?
Yes.
Yes. So that entire layer is included at a cost of $21 per unit, the highest cost basis the company has for those units. So 756 is included in ending inventory. It's included as an asset still. Then we move up one layer. And at this layer, 17 are left over. So March 17th, 17 units are left at a cost of $20 per unit and a total cost of what for this layer?
140.
One more time.
140.
No, recalculate it.
340. I'm sorry.
340. So we're going to add up 36 units plus 17 units. And how much should this equal? This needs to equal 53 units on hand in ending inventory. Is 36 units plus 17 units 53 units?
Yes.
It is. So I know that I have the correct number of units in ending inventory. And under FIFO, ending inventory equals, and I forget who it was, Christian, 1096 is correct. Ending inventory balance for FIFO, which is going to provide the highest ending inventory balance out of all of the methods. And if you notice, 1096 is higher than average cost ending inventory. So even though we're including the same number of units on hand, because of how we're expensing cost of goods sold and calculating ending inventory, they are going to come up with different values. When you add the 5,870 to the 1,096, what does that equal? Add up these two.
$69.66.
6,966, exactly cost of goods available. It's just a check to show you that we're breaking up cost of goods available into cost of goods sold, the amount that we're expensing, and the value of ending inventory. Now, is this making a little bit more sense than when you read it in the chapter?
Yes.
Yes, a lot more.
That's what I was hoping to hear. I know this is a lot to digest, so we're going to take a break here, and I'm going to let you go and finish your pre-assignment, complete your chapter 5 homework if you haven't done so, and to maybe look and start your chapter 6 homework, and then if you come back with questions for me next class. And we'll finish up LIFO next class and go through a practice problem so that you go through the entire thing yourself in class, and you can ask questions. This chapter is definitely shorter than the other ones, which is nice, right before your next test. And you have this time to go and practice a lot. So have a beautiful day. I'll see you on Wednesday. I'll hang around if you have any questions, but I'm going to pause the recording.